Thanks for clicking. The Bank of Canada may need to raise rates again, despite announcing its hold on Wednesday. This is one of the key messages taken away from a press conference with Bank of Canada Governor Tiff Macklem yesterday.
We're not done yet. You don't think we're done yet? Raising rates. It's pretty interesting.
Yeah, not exactly the body language or the quick response that many have been hoping for. And while the majority of the post-conference headlines focused on the governor's assertion that it's too early to talk about rate cuts, unlike usual press conferences, the governor was only asked about and addressed rate cuts once. Instead, the governor focused on a number of issues which could push Canada towards a new, higher normal rate, including the bank's decision to hold rates on Wednesday, whether or not Canada's 2% target rate can be changed, and the longer-term future of interest rates.
So a new normal.
A new normal.
So what I want to do today is go over the governor's press conference, including the Q&A session, take a look at where the governor says interest rates are heading, and then discuss what to look for next. Speaking of next, we are eagerly awaiting the release of Canada's national sales data for the month of August, which should be released in the next week or so. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this press conference. On to the governor's speech. Very briefly, the governor began the speech by talking about what we've gone over before on this channel. The weak GDP data led the bank to hold on interest rates on Wednesday.
The data since mid-July are providing clearer evidence that higher interest rates are moderating spending and rebalancing demand and supply in the economy.
But, said the governor, the bank remains concerned with broad-based price increases, which are still present throughout the economy.
No matter how carefully you shop, you can't avoid it. Prices for almost everything are going up, and that includes many necessities. For example, rent was up 5% in July. Home insurance and cleaning products were both up around 9%. Price increases for food average around 9%, and many are in double digits. Bakery and cereal products up 12%, baby food up 11%.
You f***ed up, buddy.
So, judging from the governor's statements, we are still not out of the woods just yet on inflation, and, as we'll see in a few minutes, rates could still go higher. And the governor took time out of his speech to address what we talked about before, one of the biggest increases in the CPI being that of mortgage interest costs.
The biggest impact on CPI inflation is mortgage interest cost. That's gone up as we've increased interest rates.
And we've talked about that before on this channel. Many, you know who, have argued that since mortgage interest costs, which are determined in at least some part by the Bank of Canada, are pushing up the rate of inflation, and if we exclude those costs, then inflation is actually within target range, that the Bank of Canada's job is done. And Governor Macklem addressed this line of thinking directly.
And if you look at CPI trim, for instance, it's excluded mortgage interest costs in each of the last 14 months. Nevertheless, it's still running at about 3.5% because it's also excluded things where the prices have fallen sharply. The underlying trend shows inflation is still well above target, and the longer the underlying trend remains too high, the harder it's going to be to bring inflation down.
So, while, as predicted, we've seen a flurry of articles saying that since mortgage costs are pushing up the CPI, that the Bank of Canada can pause on interest rates, as it turns out, monetary policy is a little bit more complicated than a single item in the CPI basket.
Let's not overthink it.
And now, the really interesting part. The governor addressed the growing number of calls that the central banks, that the Bank of Canada, simply changed the target rate.
If it's going to be difficult to get inflation to our 2% inflation target, and we'll be closer to 3 for some time, why don't we just raise the target to 3%? Besides, you have a control range of 1 to 3%. Isn't 3% close enough?
Indeed, we've seen article after article over the past year or so arguing that the central banks just change the target rate, raise the target rate, and then call it a day. And the governor addressed this line of thinking in short order, noting that you can't just change the target because you missed it, and that the central banks have a 2% target for a reason.
Banks around the world have a 2% target because at 2%, inflation is low enough that people don't need to worry about changes in their cost of living one year to the next.
And while this is definitely a good point, I think the real message came next.
Price stability means households and businesses can plan and invest with confidence that their money will hold its value.
And the governor is hinting at the real problem with changing the target rate. That would mean our currency would lose its value at a faster pace.
I'll make that deal.
We know. When we think of inflation, we tend to only think that prices are going higher. But the corollary to that is that our currency is also losing value. It's taking more of it to buy the same amount of goods. Even more of it when you consider shrinkflation and, as of late, skimpflation. As such, even if the central banks were to raise the target rate, and let's not even mention the amount of credibility they would lose for doing so.
Seriously?
If they were to raise the target rate, interest rates would still have to go higher. For instance, if I lend you money and I know that in a year's time that money is going to be worth 3% less, then I'm going to demand at least a 4% interest rate. On the other hand, if I lend you money and I know that in a year from now it's going to be worth 2% less, I might only ask you for a 3% interest rate. So, when the target rate changes, when the target rate goes higher, if the target rate goes up to say 3%, then lenders are going to demand more of a return. They're going to demand higher interest rates to cope with that loss in value. And this brings us to the higher for longer part of the press conference, when the governor was asked point blank if the central banks loosened too much over the past 15 years, if they kept interest rates too low and printed too much money.
Did we get too used to low interest rates as a result of the financial crisis in 2008 and all the quantitative easing? There were times in the past, in the 50s, 60s, mortgage rates were about 6%, and that was considered not bad. Did we just get a little complacent?
And it's definitely a good question. For the past 15 years, we've had the lowest interest rates that we've ever seen, near zero for much of the time, and many are asking whether or not we're entering into a new era of higher rates. For his part, the governor didn't really answer the question about the previous 15 years, but instead focused on the future, noting that there are a number of factors pushing up the neutral rate. The neutral policy rate, which is considered to be not stimulative, but also not restrictive.
If you look forward, I think it's fair to say, when you look at some of the pressures, which I mentioned, climate change, aging demographics, rising geopolitical tensions, the need to make supply chains more resilient, those things, and also higher levels of government debt globally, so demand for more need to sell more debt. Those things could all be pushing the neutral rate up a bit. So
now, we could do an entire video focusing on each of these factors pushing up inflation, with reshoring and geopolitical conflicts, growing pressures from massive demographic changes, and climate change set to raise prices. I think one of the key takeaways is the governor's mention of global debt needs. With global debt already reaching $300 trillion, $300 trillion, and set to increase going forward, demand for debt going forward looks like it will far exceed supply. And when demand for something exceeds supply, in this case debt, the price of that product goes up.
Are you serious?
Taking all of this together, the governor said that we shouldn't expect rates to go back to their post-2008 heydays.
I think you're running businesses. I don't think you should expect they go back to where they were in the decade between the global financial crisis and COVID. They could well settle at something higher than what we saw in the previous decade.
So a new normal.
A new normal.
Finally, the conference ended off with a light-hearted joke, though I'm not sure Governor Macklem saw it that way.
And hopefully you don't get any more letters from premiers.
Just saying.
Well, I really appreciate.
Yeah, they probably shouldn't have done that. So, all in all, the message coming from the press conference was a little hawkish, maybe even a little bit more hawkish than we saw in the policy announcement. The bank has recognized that the economy is slowing down, but is concerned that inflation may remain sticky, and is saying that interest rates won't be going back to their post-2008 heydays, with global and structural factors pushing up the price of debt, pushing up inflation. We could be in for a new normal. With that said, we will continue to track the Bank of Canada and its interest rate policies on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.